All right, we'll call this study session to order. This evening we're going to be learning about proformas.
Yes.
Our teachers for the evening are Layla Aman, Jerry Johnson, and Allison Wrights.
I think Allison is handing out some materials for you guys.
Thank you.
But yeah, just a quick round of it. I mean, you know who I am, but I'm your Community Development Director, and Jerry
Johnson, with Johnson Economics. Also teach real estate finance at Florida State.
Yeah. So he's a professor. He's in a professorial role today. And also, I do want to acknowledge he's here on his own time. So we're grateful to have a couple of hours of Jerry's experience for all of you. So
Thank you.
Jerry. So it's a bit informal, but we have an agenda we've handed out. I want to thank Allison for helping pull all this together as well. But tonight, sort of our objective tonight is to really give you an overview of effectively what does it mean for something to pencil. And kind of when we talk about a development pro forma, what are all the things that go into it? So we've put together a few examples. We'll walk through and do some activities related to that. But this is my first full study session with you guys. I'm not sure how these things usually operate, but I'm hoping it's interactive, so feel free to dive in, ask questions. We don't really have a formal
You're a lot less nice.
presentation. No decision making today. But what we're going to go through is sort of talk with you a little bit about what the real estate development process is and give you, I think the idea is to give you this mindset of a developer from your seat at the dais. A lot of the policy decisions you make can influence development greatly in the community, and I think mostly in a positive way, but sometimes those decisions can have impact on whether or not things can get developed. And I think a good example is the discussion we had around the green building standards. And if we push too far, what does that mean? And if we don't do enough, then what does that mean? And so trying to find the balance. And I think that I feel like a pro forma is sort of the ultimate balancing tool, as you're just constantly weighing so many factors. And so we'll dive into, I think Allison and I will kind of focus on the elements that the city controls, so things like policy decisions that impact development, regulatory decisions that impact development, to show you and illustrate kind of how that actually affects the bottom line. And then Jerry, day to day, working with multiple developers, is really out in the community, frankly, and really understands the market at a much higher level than I certainly do. And so,
Well, and I think it's always important when you look at pro formas. First of all, I think it's like Latin, it's according to form. Development doesn't go according to form, and almost always gets worse. Sometimes it's better, but this is what when you're looking at initiatives, when you're making decisions. So almost every development, when it's initiated, they expect to make money. They expect to make a return. They don't always make a return. Sometimes it goes poorly, but this is what they're anticipating or expecting. So, and when I teach in the Master's Real Estate program at the Business School of Portland State, we always tell them pro forma is the key about everything. That's where all decisions are made in development. Everything you do with market research, everything else, all it does is it feeds into this pro forma, which becomes the basic model of how I make a decision. Do I go forward or not? And so it just sort of formalizes all those sort of inputs.
And so to what extent is the pro forma sort of a national process? I mean, is everybody's the same across the country?
No.
Or is it very location specific?
Well, every developer
and
has their own pro forma,
Okay.
and they all think they're secret, and they'll give you, they all sort of do the same thing. We always start off with what we call a napkin pro forma, which is you sit at lunch and you sort of draw it up. And the basic thing is it worth more when I build it than it cost me to build? They should all be worth more than they cost you to build. That's the basic measure. And you'd be surprised how many projects don't pass that first screen. That's going to cost me $250,000 a unit for these apartments, and they're worth $180,000 at completion. I probably shouldn't do that project, and I don't need to go a lot farther than that.
So that brings up a question that I've always had. So you said they're worth $180,000 a unit, but they're apartments, so
Right.
they're being rented, they're not being sold.
Right.
So worth over what period of time?
Well, and that's how they get valued in the market, and I'm going to jump ahead to
Yeah.
the whole idea of capitalization rates. You have, a rental apartment project is called an income property. Well, it's usually just traded if someone buys or sells an income property. For institutional investors, they use something called the capitalization rate, which all that is the rate of return. What that means is if I have a project that kicks out $100,000 pre-tax income every year net, and I have a capitalization rate of 10%, which means I expect a 10% return on my investment, I'll pay you $1 million for an investment that gives me $100,000 a year. If I think it's lower risk, or I'm willing to take a lower return, or interest rates are lower, and I'm taking a 5 cap rate, 5% rate of return, I'll pay you $2 million for that same asset that kicks off $100,000 a year. So whenever we value real estate, it's almost always on a cap rate. For small, tiny projects, they do it off this thing called a money factor, which is how realtors pretend that don't let you know that you're paying too high of a price for your properties. You should really be using cap rates. So we almost always use cap rates. It's just a measure of how much return you'd expect to get in a normalized market. And the reason you'll want that initial threshold cap rate, or you want to get a certain cap rate for your valuation, is I can go on the open market and buy other products. So if I'm looking at doing a rental apartment project, and the project I'm going to develop, I run my Proformas, those give me a 5% rate of return, and I can go on the secondary market and buy a project giving me a 5.5% rate of return. I don't take all the risk of developing it and leasing it, I just buy a project that gives me 5.5% return. So the cap rates are really important right now, and they're very low because interest rates are really low. Rates of return in other asset classes have been relatively low, which means people will accept a relatively low rate of return for income properties. And residential income properties, particularly, they're paying very low cap rates right now, which is good to make projects viable, but it also means you're really vulnerable to if interest rates slide up or other things slide up and cap rates move. A lot of things that work won't work very quickly. The Proformas are really sensitive to what that assumption is.
So define the cap rate again?
A cap rate is just the percentage rate of return. All you take is you take a line item called net operating income, which is your net income before taxes, and you divide it by the cap rate, and that gives you the value. So what it reflects is what rate of return, if you're investing $1 million, what rate of return you're getting, at least in that first year. You're always hoping the asset's going to appreciate in value and your return will get better over time, but that's what you're paying for the first year. And those are usually pretty well established. They're pretty consistent nationwide. There's all sorts of data on it, and if you look at what happens locally, it all sort of follows. Because if you're going to buy an income property, you can buy it nationwide. If I'm going to buy an apartment project, I can buy it anywhere. So they do all sort of move together.
Or an investor or developer could put their money in outside of real estate. They could just
Right.
put their money into the stock market. So there's sort of that comparison of what sort of rate of return will they get in a development project versus I could just put my funds into something more predictable or stable.
Or something, yeah. So there's always called a risk-return relationship, but called risk premiums in economics. You normally take a U.S. Treasury as being maybe your safest investment. And U.S. Treasuries now are paying virtually no interest. Everything you think is riskier than that, they have to pay more interest to get you to invest in, right? So real estate is considered more risky than Treasuries, so it will always be higher than Treasuries. If it isn't, we've got a problem because people have lost a lot of faith in the U.S. Treasury. And then there's riskier pieces as well within, if you take even riskier bets like good investment grade bonds relative to junk bonds. They'll have higher rates for stuff that are seen as higher risk. Real estate is sort of seen as, and it's different by product, like rental residential is seen as a relatively low risk product. Office is a little riskier product. Industrial is a little less risky. The market sees them differently.
I had a question that I wanted to go back to. Earlier you said that there was sort of a break point where there were projects that were tiny and cap investment wasn't really part of the picture.
Right.
Can you define tiny for me?
Well, it depends. There's different buyers. The easy one is if you say 100 units or more, there's only so many buyers out there in the market. If I'm trying to sell a fourplex, there's a whole bunch of buyers. So then I actually get a better price if I'm selling the fourplex. I got a lot of buyers for the fourplex. And so we do find is institutional investors who buy the big projects, there's not that many of them, and their cap rates will be relatively high, and you'll see the small investors pay more because they have less pricing power in the market, and so they sort of have to accept they're competing with a bunch of people. The big guys really aren't, so they get a little bit better rate.
So a unit that was, or something that had like 25 or 30 units, would that be?
Well, and that's the in between, and so there's
Yeah.
sort of there's a curve. It's not like a big step off. It's just as you get larger, there's just less players in the
Okay.
market.
Gotcha.
So-
Thanks.
All right, so we went totally off.
Took you off script, sorry.
All right.
That's great. Do it for us.
So we prepared kind of a back of the napkin example, looking at Harrison and Maine, and then also have kind of a Proforma tool that is a spreadsheet that can kind of, we
This
can,
is mine, but you should use hers.
Oh.
I just threw this out there because it doesn't have Harrison and Maine in there. This is another project.
yeah, that,
You did which
Is
one?
it the code tool?
yep, code tool.
Got it.
Oh, here.
But I've kind of entered in some basic information about the Harrison and Maine site.
I think the previous life, Layla actually wrote this. I think.
So this, it's a model that we created for working with cities.
You have to do the enabled content at the
Oh,
top.
right.
Yeah, you-
Clearly, I've lost my touch. But it was a ways we were working with cities a lot, and they were looking at things like how to upzone and this and that, and or we were working on catalytic sites, so opportunity sites like our Harrison and Maine site and so forth. We actually worked with Jerry when we worked with council to set the affordability goal for Harrison and Maine. Jerry actually did a pro forma analysis and looked at what was the difference between 100% market rate project versus something that had 20. We had to kind of figure out what the tipping point was for the number of units that we could subsidize with the land value. So he did that analysis for us, and that's what set, if you recall, that kind of 20% threshold that we set for that site was actually based on math. Because we wanted to say, okay, the developer's going to forego revenue over a period of 30 years. We need to be able to understand what that foregone revenue is in order to right-size our request to balance that. Because what we're intending to do is get it to where the residual land values of the value of the land was worth nothing effectively.
Right.
And so, because oftentimes when we put those kinds of conditions on property, that's how we as a city can help use our land to try to get the type of development we want to see, but we wanted to do it in a way that allowed you to get what you were asking for. So instead of saying we want half the units, just because, it was a way for us to actually say, okay, the land value actually supports us subsidizing 20% of these units at 80% of AMI.
That's what I was going to ask you.
So
Percentage.
it was an informed decision that you were able to make about what we could afford, frankly.
And I should mention, we'll drop into acronyms all the time. We get used to it. We don't want to do that, or stuff that people just know in the industry. But residual land value is a common phrase. What happens for developers take the rents they can get in the market as a given. They can't affect that. They can't affect what their construction costs are. But then they solve backwards and say, how much can I afford to pay for the land? So if you get the residual land value to zero, that means there's no additional value for the land. Someone's going to have to give you the land to do the project. Normally you solve backwards, so you figure out what you can bid on property, and that's sort of what sets property values. It sets the maximum property value. Developer always pay less than that. That's sort of their back pocket number, that I can pay up to $1 million for the land, but if you'll sell it to me for $500,000, I'll take that too.
So this kind of level of back of the napkin pro forma would be used very early on. And they're basically, as Jerry mentioned, having dinner, trying to decide if this project pencils and if they want to, go after the site. There's a few different measures that developers use. I know, Jerry, you mentioned your favorite is return on costs.
Right.
There's also internal rate of return and then cash on
Cash on cash, right.
Maybe we can define
Yeah.
what those
Yeah.
three things are.
Yeah.
And then I can
Please.
explain the dashboard after that.
So return on cost, since we started with cap rate, return on cost is also sometimes called a going-in cap. It's the same idea. It's just your first year stabilized net operating income divided by the total cost of your development. So if I have, my NOI is 100,000 and I have $2 million in development costs, my return on cost is 5%. So I got a 5% return on my investment. We like that a lot because it's hard to manipulate. And when you start getting into public-private partnerships, developers have the upper hand typically because this is their backyard. They understand it and they know how to manipulate returns. But that one's hard to manipulate because it's just so simple.
So that's really for a property where you're selling it, right?
Well, you don't have to sell it. What they look for, again, what you want it to be is worth more than it cost you to build. So if your cap rate is what it cost you to build, what we have is a going-in cap, which has to be a higher rate of return than the market cap. So that might be too complicated. So let's say if I have a 5% cap rate in the market, and my cap rate is 6%, so I get a 6% return on my project. My project is 20%, 120% of the cap rate return. So what my project's worth 20% more than it cost me to build. That's a good return, or I feel pretty good about that. So that gives me some comfort that I created value by doing the development. I took a bunch of risk, but I got a 20% return on that investment, so I feel good about that. I don't have to sell it. It just means that for me, like big developers, like Holland Partners uses this one all the time. This is what Holland Partners does, who's one of the larger developers in multifamily. They always use return on cost, or they call it going in cap. It's the same thing. It's a simple measure, and that's why we use it, because you can actually monitor it. The difficulty, if you're going back and checking on projects, like we're working on a negotiation for public-private, we're working on the public sector side, they're worried that they're going to make too much return, or the city council is, right? And they wanted some clawbacks if the return was too high. The problem, if you wait for an IRR, is you don't know if that happened until 12 years down the road.
Right.
And it's really hard to figure that out, and you got to go through a lot of books, and it's very hard to do. Internal rate of return is basically you take all your cash flows to a period out in the future where you assume you sell the project, and you discount them all back.
10 years.
Typically 10 years is really common. You discount it all back and said my overall rate of return of all my cash in and out is this. And that includes financing, which can help you out if you have attractive financing rates. There's a lot of things are involved in that. It's a much more complicated measure to do. It's also easier to manipulate, which is why we don't use it. But a lot of developers use it. Like if Williams Dame is an internal rate of return developer, that's what they care about. A lot of developers that hold for a period of time, that's sort of what they look at for a measure. You asked if all Proformas are the same. The math is the same, but they all have different things they care about. Every developer does. Some are just straight merchant builders, and it has to be worth more because they're going to sell it right away. Some people are holding for a portfolio. Some care about long-term cash flows. You don't know their tax situations. Sometimes they're trying to hide or manipulate gains. That's why it's really hard to get an IRR. You can make an IRR look really bad, because then your interests align with what you're trying to do, probably with the IRS, which is make your income look poor.
We can show you how.
Doesn't mean your income is poor, but it means that you spent a lot of time making yourself look like you didn't make any money on this deal.
So going back to your definition of return on cost, you said first year net operating income
Right.
minus the cost of
Divided
development.
by the cost of development.
Divided by, right,
Yeah.
divided by, sorry. So, but I mean, your first year operating income, if you're a rental, if you're apartments, is a different thing than if you're selling condos, right?
Right.
So it's first year stabilized. If you're doing condos, that analysis is completely different. Because in fact, they even lay their Proformas out. They go top to bottom. Because you just sell. You just hold it and you have holding costs and you sell and you're out. So it's a really simple pro forma. These are set up for income properties.
Okay.
But you're right, condos is very different because you're not holding for gain. You're just, you have a draw schedule and a sales schedule, and you have to repay your loan as you sell, and then you're in and out. And if everything goes right, you're probably in and out in 3 years. If everything goes wrong, like in the downturn, there was people who were in the condos for a long time,
Yeah.
and they turned into rental apartments.
That's all those auctions that happen in South
But that
Waterfront.
wasn't by
yeah.
intent, yeah.
And then cash on cash is the developer's return on their own equity that they put into the project.
Yeah, so if you go in and you've got 20 or 30% equity, and then you pay your debt service, you'll normally get better returns. Your cash on cash should be better than your return on cost, because you should be getting what's called positive leverage, which means you're making money on the bank's money. So the bank's loaning you money at 4.5%, and if your return on cost is 5.5%, your actual cash on cash is significantly better because you're making money on the money you're borrowing. And every development that works does that. I mean, you're actually a fool your development didn't work if you're getting negative leverage, which does happen sometimes where your returns are 4% and you're borrowing money at 4.5% and getting 4%, and you're losing money. You're finding ways to leverage your losses and actually lose way more than you actually had invested. So generally, cash on cash, which is also a lot of developers like that one, because that's really sort of what you're getting.
Okay. So using Harrison and Maine as an example, we're kind of going to go through some of the different pro forma inputs. So some of that is looking at your site, it's looking at the zoning code of the place that you're looking to develop, looking at construction costs, and then looking at revenues or what potential rents you could get.
This is sorry, Nelson, this is a simplified version. So this is you're out to dinner with Jerry, you've got a few $1 million you want to spend, you guys are like trying to figure it out. You've got someone who understands the zoning. So just things to keep your eye on is this graphic here represents a few things. So from a policy perspective, as we talk about things like setback requirements and et cetera, parking requirements. So just so we're clear, so the area that's in gray is this, if you look at the full site, this is the percentage of the site that's dedicated to parking. The area that's in red is what your building footprint would be. So the way it's currently set up, which is just a starting point, is it's a surface park model. So you're only getting 38% of that site is being developed, the rest is housing parking. So it's just something to think about. And then when you add landscaping, you'll see a green stripe come in here.
That's with our current code?
This is just an example as a starting point. And right now,
I think I plugged.
no, it's a lot higher.
higher
So this is
parking
more of a
ratios.
traditional model, but I
Yeah.
can show you really quick, like, not to jump ahead, Allison,
That's
sorry.
fine.
But so for example, if we wanted to set this to our zoning code requirements, it's 0.75 for residential.
Yeah.
And then this is where I think our code's pretty rad, is we don't require it for retail, and we don't require it for office. And so you're now, but this is assuming still, just to show you the difference between a surface versus a structured model, you're still having to dedicate almost half your site to parking. And so this is a useful tool, so when we
So
created this
you're
tool-
saying that's for office, where we don't require it, but that's typically what they would feel they need?
It's typically, I mean, I think it's usually between 2 to 4 spaces per 1,000 feet for
retail.
retail, and then 2
You can
typically
get
for
usually
office.
2 for office in a suburban location. If an urban, by light rail, you can probably get to 1 per 1,000.
Right. But let's say we did that, we changed our code, then,
This one doesn't
It
have.
doesn't have any office
this
in it.
Oh, right, because there's no
program, so
office
it's a
in
big
there.
difference.
Oh,
What if
Look
we
at it,
brought
didn't change it at all.
What if we brought it down to 0.5?
Huh, yeah, I had a feeling you might ask that. So
You have to be on the residential.
that adds 10% more land area to it. So this is, we created this model to work with jurisdictions to say, here's mostly, I think when my mentor Frago, John Fraganesi, sort of created this model, and then a bunch of us nerds sort of expanded it. was really to show the impact when they were doing the functional plan of what parking requirements do to the built environment. And just trying to illustrate to more suburban communities in particular, like, look, your parking codes are killing our ability to grow up and not out.
And this is using classic structured parking, not doing the stacking like.
Well, this isn't structured at all, this is
This is
surface.
surface. So, and we can
Oh,
switch what
sorry.
that looks like as well.
I can't read any of those numbers.
I was gonna say, can anybody
really
see it?
I can almost read them.
No, if I was
In between my
15 feet
chills
closer,
for
I
being
could
too
read it.
cold.
See, I'm just getting to the age now where I can't see up close, so I can still read far away, but.
I've got the progressive, that's why I always do.
Ah,
Like,
that's
see,
much better.
The right.
That's better for all of us.
On the top and out.
So just things to pay attention to as we start to think about efficiency and how we're, like, what the land use efficiency is. So this will tell us as we start to make these edits, how it impacts the number of units, jobs, and then it gives us like floor area ratio, and then gross building square feet. So these are just sort of levers for us to understand.
One of the things to also know with like units, when we start talking about cap rates, and low cap rates are helpful for you guys on viability. If you get to institutional investors, a lot of them won't go below 125 units, a lot of them won't go below 200 units. It just takes a certain level of management and investment in a community to get, say, a relatively large project. And so there is some advantages to scale in that you'll attract some larger developers who will hold those. A lot of the larger developers won't do small projects.
And then I've heard, Jerry, 12% as a internal rate of return, as a kind of
Yeah,
rule of
12%.
thumb target.
That's not bad, yeah. Yeah, so 12% is okay. So this has a cash on cash around 10. That's actually 10 on a cash on cash is pretty good, which a 12 will get you about a 10. So that's about right.
And so this is how tall of a building?
Let's look. I think this is 4 stories.
4 stories.
So we can increase it to 5.
Well, this is the construction yield part. So when you work with developers, when they first sit down, they'll get an architect and planners. Sometimes the architects have planners working for them, and they'll do a yield study, which is what can I get on the site? And you just look at the code, you look at what you're allowed, what your setbacks are, what your requirements, and they come up with some basic sketch numbers. And they just say, look, we're going to be able to get, the 88 units, we'll be able to get this sort of parking ratio, and we're going to have this much ground floor commercial with the code. And they give them basic parameters. It's not a design, but it's enough where you can try to start to make a decision that, look, I can sort of get this much on a property. So everything you do that changes code changes whatever that number is. Sometimes there's welcome changes, sometimes they're unwelcome changes. But the developer assumes he can't do much about that.
Right.
The code's a given too. They may try.
Seek a variance and whatnot. But that's where, as we look at safe residential areas or things that we want to shift, like what do those setbacks and how do they affect it? So, like our downtown, I think our plan was to kind of go through
So
and
in
do
our
that.
downtown code, we have 0 setbacks. That's what this setup is.
But let's say we had
Yeah.
5-foot setbacks, and kind of what does that then do? It definitely dropped the units per acre by 20, dropped it by 20 units. The return's still pretty decent.
Yeah.
But from a policy perspective, it does start to impact your units, but then if you want more green, then you've managed to deliver something there. But let's say you have like a 0-foot setback in the front, but on the side, where it's maybe abutting a residential area, for example, and you want to do a 15-foot setback, it gets you to a similar kind of thing. So it allows us, when we're looking at zoning code, for example, to say, how is this going to impact development feasibility? Because I think you'll hear me say this tonight, you'll hear me say it next week. Kind of one of my guiding principles too is make what you want to have happen the easiest thing to build. It also means making it feasible for developers to build it. So our current code requires no setbacks in downtown.
And then something we've talked about
It also requires no surface lots.
Correct.
So how do we
So
plug
we
that
should
in?
change that, shouldn't we?
It just says no surface lots facing Main, I
Facing Main
think.
Street,
Yeah, so we could have one on McLaughlin probably,
Or
but
on
we don't
here.
want that. So what happens then when you switch it to a surface or a structure? And so the way the model's set up is that you have 2 levels of structured
So it's structured above ground.
above ground.
Yeah. What's interesting, this makes the returns better, but I would actually suspect it depends on the cost
The
numbers.
cost-
Well, that made the units go up too, and
What's
that
your
makes
cost?
no
No,
sense.
No, it does,
Your-
because
your
you're
units will
now.
go up,
Yeah, your
sure.
units go up because you're building footprint. Let's just go back.
Oh,
to
I
the-
see, because
Yeah.
you've
Right.
got nothing on the
You'll
ground.
get more
Okay,
units.
got it.
So let's just say you go from a surface park to 1 level of structure, you've added 25 units, just like that.
But that's not figuring that there'd be units on the bottom floor, is it? Because that's supposed to be retail.
Right, the way the
Right.
model, so this is again
Okay.
kind of back of the
So it's
napkin, it's
just
a
a-
great question.
Yeah.
It's set up for retail currently on the ground floor.
Oh, okay,
And then residential above.
yeah, all right.
And I think, as Jerry's pointed out, which is correct, is that probably the cost of parking is not actually reflective of what it costs to build it. So like, these are, to me, wicked low.
Yeah, well, construction costs, just so you know, are up like 30% in the last 2 years.
Yeah.
So
So we could, let's.
things are
monkey
very
around that.
expensive. So
So like what
your
would be-
residential should be $175 for wood frame.
Okay.
Okay, so this is 5-story building.
175, sorry, a minimum, yeah. Your retail, that could be a shell, but you're gonna have to do a TI.
Right.
So you're probably also in 175, that's all done. And your office is probably gonna be $200, because you're probably gonna have to, tenant improvement, a TI is a tenant improvement, which means if I get a retailer, I've gotta pay for their build-out too, some build-out for them. Now, a lot of the retailers, you can probably drop the retail down to 150, because you normally negotiate the lease what they build out themselves.
Right.
But the office tenants, you normally get a tenant improvement allowance in there to allow you to put some walls and things in there.
But like on a public project.
And your
when-
parking space,
Uh-huh.
for a structure at 9,600, would,
Yeah, and that, we need to adjust.
that per space, it's a little, it depends if it's a podium or if it's a
Right.
true structure.
600 is cheap.
Yeah,
Structure's
a
probably
structure's
3
like
times.
65,000 and a podium you can get off for like 21,000 maybe.
And do we know
I
what
don't know if you can
math
add
is
it.
for what they did?
Oh.
Protected.
Oh, it's protected to
Yeah.
keep you out of it.
Yeah. We should look at the more detailed one, because that's a big driver, because
It's a
it's,
huge
yeah.
driver, and the reason you don't see the structured in that, there's a really simple rule of thumb that we've used before just for structured parking viability, is you take a look at land values per square foot. Parking space is about, surface parking space is about 350 square feet. And so if land values are, $100 a square foot, that's 35, and I can build a parking spot for $35,000 a space, then maybe and I recover that land area that I wouldn't have, I can use that for development, then maybe that's my break even. But if land values are like $50 or $75, which is closer to what you're gonna have here, it's like I'm gonna actually lose money on that parking spot. It's just cheaper to do. Of course, sometimes you won't allow it, which is actually an option. You don't allow the development form that they may want to do. If the other development form is still viable, that's okay. You just have to make sure that you have it disallowed everything viable, and so that nothing works, because then nothing happens, and that's actually a completely rational response to the market.
Right.
Yeah.
That you set up this whole case where I can't make anything work. So you always have to be careful that you've given them, they're like electron, they'll take the path of least resistance, but you
Yeah.
have to give them a path.
It's
And
always
if-
kind of like the Gateway Town Transit Center example.
Yeah.
Where
where they set it too high and nothing happens, yeah.
so this is where zoning gets set in an aspirational way, and then you have property owners that hang on to that because they're waiting for the market to catch up so that they can sell it, so then nothing happens. Or you set it too high, the minimum's too high, and the market's not there, so then nothing happens. And so it's just, again, it's the balancing act of, we want to be aspirational, we want to upzone the heck out of all of this, but then you also have to deal with human nature, right? Which is that property owners are going to want to hang on to that until the market catches up, and that 5-10-story building that they want, that will get them a land value that's 10 times what their value is. You might be doing more harm than good in that sense, where you're trying to increase capacity, but in doing so, you've now created a market condition that makes it so that those properties just stay, and that's what happened in Gateway.
Well, in Gateway, there was a center, we talked to Pac Trust, who owns that
Yeah.
retail center there, right? And the zoning required them to go to 1.0 FAR floor area, which meant they had to go structured parking on a suburban retail center. You can't charge for parking in suburban retail. The center looked like it did in the 1980s because they couldn't put more than so much money in it without having to bring it up to the new code. And so not only did they not get new development, they sort of like almost
Stagnated.
became slumlords where they had to just sort of keep throwing some paint on this thing, but they couldn't do anything to it. And so the city's, clearly wasn't the city's objective, but you also weren't moving towards a price point where you were actually going to make some of these things work. Because you'd like to see investment and reinvestment, and then the rents get better, and then over time, you're moving in the right direction so that this thing starts realizing the densities you're hoping for. If you get too aggressive, you kill all the development, and then you're not moving forward. You're not getting any development, and then you sort of become the overlooked area.
Yeah. And it's a tough thing because you're trying to be aspirational, you're trying to do the right thing. So I think there's the idea of being that incremental change is actually a good thing because you can do, it's like what is the market doing? Where is that tipping point? And if you set it to that, then you're likely to start getting that incremental change.
For some of the jurisdictions you see with the shadow platting,
Yeah.
which is basically you come up with a multi-phase development where you show how you haven't laid it out in a way where you've precluded further intensification of uses when they make sense on the site. A lot of our old zoning where you had setbacks on all sides and you put the building in the middle,
Right.
it just made it so you could never do anything with that building unless you tore it down. This way you could basically let someone do something in the interim as a phased development and keep some capacity. I mean, there's always a risk you never get the second phase or the later phase with the capacity. But, you can also argue it's probably better than getting nothing. And at least someone else maybe in the future might do it.
And the forum can be designed such that I think we worked on a project in Beaverton where there was
Yeah.
shadow platting, and the design was that it had the urban forum, so you don't have the parking lot on Main Street, the buildings at Main Street, the parking lot's at the back. And then over time, as the market starts to come up, then you can build that building behind it that has the structured parking, and maybe you're building it around transit, so you don't need as much parking. And so, again, just kind of that idea that incremental change is probably the most likely to shift the market as opposed to massive upzoning, frankly, that might actually stymie.
Well, and some of that you see, like, for examples of where it's happening now, like at Clackamas Town Center where they built the structured lot, they built them in Washington Square. Now we're working on a housing project that's taking a piece of the Clackamas lot now and redeveloping for housing.
Really?
It's not public yet. So.
Oh.
Well,
Wow.
It is
But yeah.
now. It's now
Is it now?
public.
Okay, good. I never know. We always,
Yeah.
No,
that should
No,
be this
I-
India.
I mean, you just said it on
you just
air.
said it, it's public.
You just said it on air. Yeah,
All right, well, yeah.
that's on me.
Such a thing. But, those are the things you expect to happen over time, is that, look, we find ways, when the land value gets high enough, that justifies me to put the structured parking, and then I can sell the land, and I come out better, right? I can build that garage, and I can sell the land, and that's a positive for me.
So what was the thinking? I mean, they built that garage and built the expansion of that mall kind of at the
Back
peak
when
of the,
malls
at
were doing well.
2007, yeah. So was that the thinking, that they were going to need that and they didn't really need that? I mean,
Well, they don't need all the parking clearly now, but the malls have been, they've lost a lot of anchor tenants too,
Yeah.
which
right,
reduce their parking need. Malls are going through this whole evolution, so we're gonna see a lot of,
so rather than split off some of that further out parking lot and just let it, that's further from the mall, and let that be redeveloped for housing, they want to rebuild the garage.
no, they put the garages, they're just realizing they have excess space that they can take on the periphery.
Right.
So it's more
Right.
likely to be the stuff farthest from the mall. that
Oh,
they pull
okay,
off, yeah.
okay.
So I had a question because I heard, there was a lot of talk about doing something similar at Lloyd Center.
Yes.
And then it seems to either has fizzled or there's a lot of non-disclosure agreements out there.
There are a lot of NDAs, yeah.
So what did they do differently from Clackamas Town Center that we're seeing it actually taking root in Clackamas Town Center? And are there any lessons there for us to learn as we're thinking through? I mean, the Beaverton example is way closer to anything we would have, but I'm just trying to see if there's anything we can extract in terms of long-term planning lessons around parking and the way we think about it.
Right. I mean, the thing is, the Lloyd Center has a lot of structured parking. It's not always convenient, and it's not,
In its current iteration.
it's very odd.
Yeah.
Some of them are very odd. People take the one garage because it's pretty straightforward. You know, it's interesting, if you talk to Fred Brunig, who's Center Cal, who did Bridgeport Village, he says people will drive around for like a half hour looking for a surface parking spot. They will not go in this garage. Because we have that garage, you can always park in it, but they'll just wander around because they don't want to go in the garage. And so people actually do have a bit of an aversion to garages. And even in areas like, and for reason, if you go to the garages in Salem and Eugene,
Yeah.
those are scary garages. They're not well lit. They're not, people who work there in the city, in both cities actually, are a little freaked out about going to the garages at night. You do have to be careful with garages so they feel good. Now, if you talk about a residential project like this, and it's direct secured access, that's actually a real positive, because what we find for a lot of people, it's security, that you can get out and gate closes behind you and you get your groceries out at night and you go straight in the elevator and go up. That's a real positive. And so people like that. For retail, it's always been a difficulty because people, for some reason, just don't like structures with retail. But even at Lloyd Center, you can go in that garage by Nordstrom and you can park pretty easy there because people won't go in that garage.
That's because 15 years ago there were shootings.
That could be it.
Well, there's nothing in Nordstrom's anymore.
There's no Nordstrom's anymore. I remember when it was an outdoor mall and it was
You can
cool.
fix all that, just don't go to the Lloyd
Yeah.
Center Mall. Stay local.
I think it's a little more urban over there too, just
Yeah.
the planner narrative is that
Yeah.
it wasn't before, but the proximity to the central business district, the proximity to the light rail, which
So the old
Clackamas now
Nordstrom's
has, but
going to be a Live Nation concert venue with other smaller venues, and they're doing a bunch of different things. They're going to convert a lot of it to office space, actually.
Right.
They've just sort of given up on the mall at the scale it is. We're seeing a lot of this because of the, increased share of stuff that's going with online sales and stuff. The brick and mortar stuff is just getting hurt everywhere. I mean, I guess I'm part of it too. I never shop anywhere. We just
Jeff Bezos.
just have it
Butcher.
sent. Yeah, I know. I don't know how many paper boxes are wasted sending stuff to my house.
So I switched to the more complicated one.
I see that.
In case we want to address things like
Okay.
parking costs.
Yes. Okay. Oh, you opened up the full one.
Yeah.
Yeah. Yeah, I opened that up too because I was throwing stuff in my version.
Yeah. So what do you, what would it?
Above ground parking, I would put it in like 21,000 for development costs. That's gonna make it sad, unfortunately.
And then this is still probably like 90.
Were you saying 35?
Surface.
3,000.
And one of the things you run into with these costs, it depends on the scale of your parking garage.
Mechanical is more expensive?
Mechanical's less per space because it's like 15,000 a space.
So why does that say 55,000?
These are just ignore this. We're gonna,
You're going to fix all that?
yeah.
Yeah. The stackers are the cheaper way to go.
That's
You
what I
just
thought.
build it higher and you do the stackers.
Yeah.
And it works for residential.
And then
It's
you-
hard for office because everybody
Yeah.
leaves and comes at the same
Oh,
time.
yeah.
Right.
But
Right. Where am
I don't know what that is.
Say,
I? Okay.
with, also in financials, I think is the rents down below.
yeah, what do we got for rents?
And I think, so I just
We're gonna
pulled
do-
Oh,
the,
basic financial.
Yeah, your rents.
Where?
there you go.
Okay.
So this is what we're
See
seeing
the
about
weighted
that
average on the
asset
bottom,
tree.
a little bit farther
Yeah.
down. Oh, yeah, so we're 236.
Jesus.
Yeah, which you need that to make the development form work. Just so you know, you get much less than that, and that's not gonna be close.
Now, is that calculating the cost per unit at 250, 300,000? When you say it's not affordable,
Yeah, because the cost is monthly.
What's the rent? Do we have our new construction?
Here they are.
Here they
The
are.
cost per square foot.
cost per square
We don't have a per unit one, right?
We
But
might, I'll
say 211.
drive around.
176.
Yeah, so your total cost of 211, that's about right. Probably because I just told you what bunch. If I think it's right, doesn't mean it's right.
211
I totally
per
agree.
unit?
211 per square foot
Oh.
to build it.
Yeah.
Yeah.
And then to rent it, you're saying those numbers
Right.
Those
for
are the
monthly
actual
rent.
tree rents.
Yeah.
So you get
Those are
236
actual tree
a
rents.
month.
Okay.
Now, when
I
you
thought they looked.
look at
And
that
square
cost,
footage.
your cost per actual net square footage, rentable square footage will be higher than that because you're going to get maybe an 83 to 85% efficiency ratio. So what that means is your lobby and your corridors, you can't rent. So you're going to have to build an extra like 15% or more space that you don't get any income off of.
But so are these numbers, you said these are actual tree rents. Do you mean you fed them in, or are those the numbers that are being created based on the
I
data
added them.
above?
Yeah,
You fed them
we
in?
put them in there.
Okay.
Because if I'm, the developer that's looking at this Harrison and Main site, I'm gonna look around at what the comparable rents are.
Right.
What could I rent a
Right.
studio, a 1-bedroom and 2-bedroom for in downtown Milwaukee?
So you want the Guardian project to get really good rents because that'll tell them that this is one of the things we first talked about doing this sort of projects is you have these proof of concepts. The problem everybody has, when we actually worked for Guardian and did their pricing on that site, there's no comparables that support their pricing in Milwaukee. You've got to go to Selwood, Moreland and say, look, we can price equivalent to these or other areas. But it's really hard to pitch that to the banks and the financial institutions. But if you get one that's getting those rents, then it's a really easy case to make. I talked about the risk premium and what sort of return they want. When they think the deal is riskier, they want more return because they're concerned that they won't get those rents.
So
So-
I'm curious about the differences between, the numerical differences between like studio, 1-bedroom, 2-bedroom, and then 3-bedroom, because there's like $1,000 basically between a 1-bedroom and a 2-bedroom, but we're only showing a potential, I realize that, $50 difference between a 2-bedroom and a 3-bedroom.
Well, if you're pricing under them.
I mean, something
We actually
something probably
get
needs to
the-
change.
Yeah.
Yeah.
Axle Tree doesn't have any 3-bedrooms, so
No, I know they
change
don't,
those.
right, yeah, and so we didn't have a comparable
Right.
to go by, but if we're just hypothetically using comparables, it seems to me, yeah. But at the same time, the studio and the 1-bedroom, there's just a like $225 difference, but $1,000 difference between a 1-bedroom and between a 1-bedroom and a 2-bedroom.
I thought their 2 bedrooms were like 22. Did they raise them to 24?
There's different,
There's
Oh, there's different floor plans,
Yeah, so I
yeah.
kind of picked one in the middle.
Okay.
The studio to 1-bedroom makes sense to me because you're still only probably occupying one person.
Correct, yeah, but it just seems curious that there's like a smaller, really small difference between 2 levels and then a huge difference and then almost no difference at all. I mean, if we're hypothesizing 3-bedroom,
Right.
it
Then we
seems to
should
me,
be guessing higher.
unfortunately, it
Right,
seems to
right.
me that should be at a higher rate.
I agree.
Right.
But can we put in, could you do this, like your 211 per square foot cost? And you just say, I've got 4 floors of this many square feet, and it's 211 of square foot, and then have it generate what you need to make?
You mean solve it backwards? Yeah, you
Yeah.
can solve these
Yeah, solve it
backwards.
backwards.
And we always have we use the goal seek all the time in Excel.
Yeah, goal seek is your friend.
Goal seek is you tell it the answer you need and then tells you the assumptions you need to make to get the answer.
Yeah.
It's solve backwards.
Yeah, that was something we would often do, because, you would start, like, we would input all the costs, and then we'd look at the rents and say, okay, what do we need to get to an internal rate of return of 12%? And so you goal seek and figure it out. And then if you're way out of the ballpark, then we would work with jurisdictions, say, okay, what happens when you reduce SDCs? What happens when you do a property tax abatement? So that we could help them decide on incentive packages to get the type of, because especially if, like what we're doing with Coho, we're trying to do kind of proof of concept catalytic project, so we don't have a comp, and we do now with Axle Tree, but that's how you would start to have that conversation in a in a way that would get you to a meaningful outcome. So like we found, well, we can keep going through the thing, but when we started monkeying around with this together, we were like, what happens when you eliminate the property taxes? Well, it has a massive impact, but if you
Right.
reduce SDCs, it's like negligible. So
Parking ratios?
massively impact.
Parking ratios help because parking ratios lose money in
Yeah.
most contexts.
Yeah.
Um,
I don't want to make you dizzy by going up and down. I'm sorry. It's been a few years.
Yeah, I mean, we've been working on the zero park, don't tell the neighborhood groups that, because two of our clients do zero park departments. But the
They
city
just
of
heard
Portland
everything you said.
quietly encourages you, but will not stand behind you when you go in front of a neighborhood group. They think it's great, but don't let anyone know they think it's great.
Right.
Yeah.
So that was just going back to our normal.
But that works a lot because the
Good
parking
one.
loses money, so if you can take that off your Proforma, it'll help you out.
A lot of the public would like to see this, right? And then
Yeah.
at least one space for residential or retail.
I think the city of Portland did a survey, though, of the zero park departments of what people actually had for cars, and it was about 0.5 is what they actually had on average. You know,
That's what I pushed for 3 years ago.
It depends on your market, though, it really does, on who you go after, because you run into like empty nesters will have cars, and even if they don't use them. In fact, we actually have problems sometimes when you have good transit access and it's a high-end project.
Right.
Because they have a car, but they leave it in the garage, so you can't do shared parking either.
No, because
It's sitting there all day.
Well, we've also talked about what if there are ways for us to incentivize or require car share as part of a development so that you can address some of those
Right.
people who just really want to know that if they have to have a car, they can get one in their building.
Yeah, you know, 'cause that wasn't for a while, and the thing is that there's a market demand for it, most developers. For a while, they were doing the zip cars and the different car shares all the time. They've been doing it less because everyone seems to have gone to Uber. Now their new thing is having an Uber pull-out, or an area where the Ubers pull up
Yeah.
on your curb, where you get a couple of parking spots taken out, so the Ubers can all back up,
The loading,
pick
unloading.
people up. It was all about car shares for a while, and it's funny, they go wherever the market's going. Developers don't care, this is whatever the people are asking for, and so now they want their Uber, and then they need their Amazon Prime delivery guy, has to be able to stop, jump out, and run your food up, and come back down too, so.
Oh, there's that.
Yeah, and when you have a constrained parking supply like we do in our downtown, then a strategy like that is probably something we should think about.
So kind of the second half of the conversation we wanted to have was what's the role of the public sector and what sort of levers do we have to push within this pro forma equation, and kind of when can a policy decision have kind of positive impacts or negative impacts on the profitability or the feasibility of a project. So I think it's a little bit of let's set this up.
Yeah.
So it's the development that we want to see.
Yeah.
So that's maybe underground parking or internal parking.
Going straight for the gut hole there.
We can't do underground, can we?
You have a water table issue, yeah.
Uh-huh. But that changes things.
You do a
Oh,
5
okay.
over 2.
So maybe tuck under them at least.
With variance, you could.
5 over 2, 2 stories of
Yeah.
structure and then 5 wood.
Pedestal.
Yeah,
With the,
we would need to increase there.
We can do that in the north end for sure.
Yeah,
That's the product they do up in Seattle. That's the thing in like Bellevue, or if you get to the burbs in Seattle, the higher end burbs is the 5 over 2. They didn't allow it here for a long time, and I think they allow it now.
they do, yeah.
Yeah,
Portland?
yeah.
You mean they didn't allow it from building code
The
perspective?
building code, they didn't allow where you could do the 2-story within the 5 on top. And the problem is when they had 4 over 1, but the 1-story of parking, if you did retail, you honestly ran out of parking, and then you only went 3 stories of wood on top because you ran out of parking. And to do multiple stories you couldn't do, so.
They just started doing, I think, a couple years ago. My brother's actually an architect, and he went to the city, and they approved an alternative means and methods, which is an alternative to the building code, to do a 5 over 2. And so now I think it's become standard practice.
So does that mean one retail ground and parking on top, one layer of parking, and then 5 of,
You probably have a half
Housing.
layer of parking and a retail
Yeah.
in the frontage.
oh, okay.
And then,
But the 5 is 5 stories of stick and then 2 stories of concrete.
Concrete,
Or
right.
steel frame construction.
this is always something to keep in mind, when you're talking stick frame construction, which is the cheapest construction type, and you're talking about public interventions of watching the prevailing wage issues. When you trigger prevailing wage on stick frame construction, you increase cost by like 20% or more, because that tends to be non-union. If you're into, steel or concrete or PT slab, that tends to be union already, so that there's
Right.
not a big impact. But wood frame construction, it has a pretty big impact to go to prevailing wage. So you see a lot of developers, you're offering them $1 million, but it's going to cost them $5 million in cost. They don't want the $1 million.
Right.
So never mind.
Because any financial investment of a city or public entity that's over $750,000, it triggers the Bureau of Labor and Industries of bully wages.
Does that include trade-offs for like affordable housing and things like that?
If there's cash that goes into it, yes. Things like land value, if there are requirements that are above and beyond what the code requires, then those things you can work through with BOLI, because the city's setting conditions that are putting a financial
Right.
burden.
So you can make the argument that the conditions has taken away the land value, so I'm not giving it to them.
Right,
I'm giving it to them with conditions that make it valueless anyway, so there's no net gain.
right. Tell me what to do,
Yeah,
boss.
so one of those, like so let's look at what the land value is
Yeah,
currently.
okay. I have the more complicated one open, I can go back.
I think just the second tab, building financials, will be the simple one.
Okay.
Yeah. So I think we have it at $50 a square foot, go up a little.
Oh, there it is.
So it's a $2 million land cost. If,
Right.
kind of given the public benefits and the development type that we want to see on the site, we could argue that we want to reduce the amount that we would sell the land for.
Right.
So let's say $1 million.
So you got their return up a little.
But
Yeah.
say $0. Now it's closer, but say that $0 comes with some strings attached, which
So now more affordable.
usually does, right? So let's say now, we're
Where's
going to
this
do
unit mix on the affordable? I think it was in a different sheet.
I think it's in the building
building.
envelope.
This is what it's like to do Proforma. You're like, what did I
The
do?
sheets are all over. That's why it's so hard to read someone else. Everybody does this
No,
different.
I feel like
Can
we
you
should-
make that go full screen and then we don't have that header and we can see more of the page on a given
Now you're
page?
gonna test my Excel skills on
No.
camera.
You can pull top arrow to the right.
Which one?
Yeah, up there, the little,
There it is. One up, one up, one up.
This one?
Yeah.
Ah,
that's better,
Still there.
yeah.
Yeah.
oh, I see.
Gives you a little room.
Breathing room.
So I
Trying to
think,
look for the percentage of the
I
building.
think it's in building envelope.
There it is.
Um,
I used to be able to drive this thing,
Yeah.
and nobody's.
So residential, oh yeah, so this would be, do we have 5 stories right now?
Oh, no. Oops, sorry.
So then we'd have 20%,
Well, of course you did
Retail.
2 stories, so does it count as 7 or 5?
What's that?
Is 5 stories of wood on top of the parking, or is this,
oh, that's a good
it's
question.
7 total, it's 5 over 2?
Yeah.
It's 60 feet tall. it's just
Currently
five.
downtown,
Yeah, so this is.
you'd be hard pressed to
yeah.
get
You'll never get 7, because that'll be like 75, 80 feet, so
Yeah.
you're not gonna get there.
So then here's our affordable, so right now it's 0% affordable.
Okay, where is it? Oh,
Right
got
there.
it, sorry.
So if it's 20%.
Oh, it's percentage,
20.
that's right.
Yeah,
So then we'll.
Take 10 off the ones in the studios, I guess. and-
yeah.
There you go.
So even though you gave them the land.
The returns are lower for the,
Returns are lower.
so that requirement costs them more than $2 million, basically.
Well, we'd reduced it to 1 million, right?
You reduce the land to 0.
Zero.
We-
Oh, to zero.
We did
You
it
Right.
gave the
zero.
land for
Yeah.
free, but
Okay.
then what you asked them to do was
Too much. Yeah.
more than $2 million worth of.
and that's, where are you plugging in the 80% AMI?
Oh, that was here. So we just, right now, it's just sort of a, where is it? Here,
You have the number.
up there. So that's the percentage, and then if you look at the financials, that's the rent. And so it's a blended average, just it's just a
Okay.
back of the envelope. But let's just say it's sort of, it's about half of what a market rate unit is. But this is, I think, where is the property tax? So property taxes, so downtown, I think this is something that we need to remind ourselves. We've done quite a lot in terms of trying to get more housing
An abatement.
and abatement. So the vertical housing tax abatement program is, I think, has one of the greatest impacts on the ability for a developer to build something like this in our community. And so it's a little more complicated than taking it down to zero, but let's just do it for fun. It's fairly close to that. So if you take that to say, your property taxes are going to be waived for the first 10 years, what does that do? Now you're in the green, right? That has massive impact. So we think about things like low-income housing, tax credit abatements. Like tax credit abatements are probably one of the biggest levers
They
that.
are. It depends on how developer sees them though too.
Right.
Because some will do it this way, but the ones we work for won't.
Yeah.
Because it's only good for 10 years, and so in year
Right.
11, you have to start paying those property taxes again.
Right.
So we'll actually take that, you save $400,000 a year for 10 years, discount it back and say that's worth
the value.
less than $4 million. That's worth maybe 3.2, whatever our discount rate is. And just say that's sort of a reduction in cost. But a ton of developers will do it exactly like you just did it too. They'll take a look at the NOI and say it works. Because we talked about return on cost, my little measure that I like to use. This takes your operating income and goes way up. It just went up $400,000. So if I'm dividing it by a 6 cap rate, that's a lot of money. So it created a lot of value.
So, but then we're undercutting our urban renewal district.
And your renewal is just money, so that's the problem.
Yeah. Yeah, you're
So-
constantly having to, you're, right, you guys are constantly balancing.
What are your parking assumptions on this?
Let's see, I think I did a 0.5 or 0.8, so we can do 0.5.
Take it to 0.5.
Yeah, see, here it
Seems
actually
bet-
got better.
And if we were
Are we
to add
getting
in,
revenue for our parking spaces in this model?
I think there is. but
Is
I
there,
really
no,
don't.
sorry, it's very, I'm sure there is somewhere, I just,
and what happens if we add in like a 10-foot setback on one side so we get a little bit of green space?
What happens? Would you like the front, the side, or the rear?
Surprise me.
Okay. I'm gonna go to the back side.
there you go.
Which is what, McLaughlin?
Or
That's what I'm
21st,
thinking of it as.
depends.
So what happened there?
Would you wanna
Did
hang
the
out?
number
Why did it
of
go up?
units- So your return doesn't change, but the number of units drops?
You got less, yeah,
Yeah.
which would make sense, you're not changing development form, you're
Right.
changing,
They're just sort of,
you're building less.
right. So your footprint changes. This model also accounts for step backs. So our current code requires step backs on floors 4 and 5. So if we start to increase that, so that would be like 20%.
Are they 6-foot step backs? I'm forgetting.
One of the things you'd also remember, you do these setbacks, your plates get less efficient per units. Because when you give them a smaller floor plate, they still have the hallways and the fire safety stairs, and you just end up making them less efficient. They tend to not work as well.
And you probably remember that from the discussion that we had of just how a lot of these buildings are built, is that there's efficiency where the plumbing goes all the way up to the 5th floor. And so there's efficiency that's lost when you start to do step backs like that. So there's just a trade-off there in terms of design versus efficiency.
You can do cool decks on top though.
You can do cool decks, but you lose units, so we're now down to 114, so we've lost about 15 units, but.
Another one is looking at system development charges, so either waiving or
Financing.
financing.
Financing of STC is actually one, the waiving, they love the waiving, obviously,
They
just
love-
reduces cost. If you finance them, it also helps them on a cash flow, and they'll actually appreciate that as well. It has a tangible,
We have.
So that's that Bancrofting
Yeah,
thing,
correct.
right? We have
Yes.
that.
Yeah.
They can do that, right?
right.
Yeah.
But let's just say we dropped.
Did Axle Tree take advantage of that? No.
They used vertical housing, and then they got a metro grant. I think is the only public But now you can see how big that vertical housing tax abatement was. So let's say we just drop our impact fees, because we only control like 25% of the fees that we charge. So if we drop that down to 3%. So we're now in the green, but to get into the green, we had to eliminate the cost of land, we had to reduce our parking value, we had to put a tax abatement in, and then we reduced impact fees.
Get rid of her green space. Who wants a green space on McLaughlin?
Okay.
There's a whole big
Might
green
want it on
space
Main
across the
Street.
street.
I was just
Yeah, it might be 21st, it might be
Yeah, well, we don't allow
Monroe.
it on Main Street, so it has to be either.
I love this conversation. So let's go back. So it still leaves us in pretty good shape.
It gets back some units.
So the jobs on site and the jobs per acre are assuming first floor retail, that's what
Yeah.
that is? Okay.
Right, and that's supposed to be just typical retail
Yeah,
measure.
it's just sort of
And you really don't know unless you know the retailer,
Right, right.
and then they're gonna re-tenant it every 10 years, so you don't know what
Right.
it's gonna be long-term anyways.
So we would develop models like this when we were looking at making zoning changes and trying to do capacity analysis. So we do
Right.
sort of like a high-level look at an area. We do a calculation like building the land value or things that we think might turn over. I actually am very proud to say I did this for my graduate thesis about 17 years ago. And I looked at division, because I grew up off division.
Oh, nice.
And I was like, I wonder which one of these are gonna redevelop. So I had a whole map where I estimated that, and then I used this kind of tool to say, okay, if this happens and these things change, then over time, we can expect to see 500 units get built, this much retail. And sure enough, I actually found that map recently. I was going through some stuff, and I was like, I was right. To me. But it's a tool like this as we think about zoning. It's helpful to say, okay, well, if we do this and we think these things redevelop, we can roughly estimate that this is the number of units we would get over time. These are the kinds of jobs we might be able to create. So as metrics for decision making. So just my pitch I just wanted to talk about my thesis work. I'm very proud of it.
A lot of these models, and they're super sensitive to all the assumptions. Just understand that the assumptions move all the time, and they're hard to get right, but it's useful to at least understand the relationships when you do things on like zoning and codes and stuff. Because what the cap rate, that's going to vary over 20-year planning horizon all over the place. All these things are going to change. But it's just useful to know that when I do this, that this actually affects how many units I should expect, or the level of investment, or what it might look like, or if that'll happen at all. It's all useful to have, and people argue about these all the time. In fact, whenever we get an open bid on a development project, like if you guys take this out to bid, and you get 4 developers going after it, the one that's going to have the most aggressive assumptions will pay the most for the site, or to give you the best deal, and then they'll probably be wrong because they were the outlier with the most aggressive assumptions. It's not your problem necessarily, but it can be. We're doing a public-private right now where the guy got the site because he was very aggressive on his assumptions, and this group had a really cool design, which we told them at the outset, this isn't going to work. And sure enough, they actually made their numbers better after they got sole negotiating power, and now they're looking for $20 million. So, which they're not going to get, but it's one of these things where you always have to watch when you do these negotiations, because people will get very aggressive, and then they'll do more due diligence and realize, oh, maybe that isn't going to work. And then they come back to you. If somebody makes a mistake and loses a lot of money, it's not necessarily your problem. Like River Place won a lot of awards. The developers completely got obliterated on that development.
Really?
Oh yeah, they had to pay their partner to let them get out of the deal. They lost so much money. So that was Columbia Lambert Development, which was a development arm for Portland General Corporation, which owns PGE, and Weyerhaeuser Industries. So 2 very deep-pocketed groups that did a really ill-considered deal and lost a ton of money.
Wow.
But the city got the project, and at the end of the day, they were happy with the project, and the fact that they lost money shouldn't keep anyone up at night. But when you talk about you guys doing demonstration projects, The danger is you do the round of Beaverton is what I'm talking about, right? So you do a project that's disastrous, right? And the developer loses everything. He lost his kid's trust fund. I mean, all sorts of things were pledged on that deal. Everyone in the industry knows what happens. And there was lots of problems with that project that had nothing to do with the market. You shouldn't be able to make a project work on that site. That was just poorly done on a lot of levels. But it created this bad vibe in the community, and nobody would do Beaverton for like a decade.
A long time.
They're really afraid of it because, we're going to get killed with these things. We'll never do one of these things again. It took a long time for people to get past it and a few successful projects to come back and be in that community. So I say you shouldn't worry too much about developer on a public-private if he loses money. If he made a lot of money, he wasn't giving you money back. So if he doesn't hit his numbers, it's not your problem. But at the same time, you do want developers to be somewhat successful because success breeds replication, and people will follow successful developments. And you want multiple urban developments in your downtown. You want the person to at least be able to present the fact that he was successful. Developers will always say they were more successful than they were in projects.
So how transparent is it when a developer is successful?
They can't be too obvious about it because they have to make sure that they haven't shown too much gain. If it's a public-private, it's bad to be too successful because then it looks bad. So developers will keep it a little bit down, but they'll talk how well they did on deals, even when they haven't done well on deals.
Yeah.
But you never really know what the real numbers are, honestly.
That's what I wanted to know.
Yeah.
There's no
It's
checking.
really hard to get back at. That's why we try with the real simple measures.
Right.
Because look, I can actually get that number. If your IRR, until you sell it, and I don't know your whole capital stack, I can't figure that out.
Right.
So I don't use that, not because I don't think a lot of developers use it, it's just that I can't monitor whether you actually did what you said you did.
And I just would add, sorry.
Go ahead.
I just wanted to add two things. When Jerry brought up Beaverton, I think one of the big mistakes that was made there too, that we won't, which is they sold the land before the developer had its financing in place, and a lot of it was privately financed.
Right.
So when they went bankrupt, the city had no recourse. And so that land just sat there for almost 15 years before anything happened. Stuff's only just now happening. So that's just something to keep in mind as we work on our agreements. Like the way I always talk to you guys about it is that we don't transact on the land until we know that they're going to start construction like tomorrow, which means they have all their equity, they have all their financing stacked up. And so when they close on financing is when they close on the land. Because then that allows us to back out at any time. Because if it falls through, that's still our land. And so we need to protect ourselves. And then I think the other thing too is that you have Allison and I now, and then usually when we evaluate developers' proformas, I have a good example of a project in an agency I used to work for. A developer came to us, and one of our criteria was you had to have a financial gap because our job was to try to help finance. We were trying to develop developers and do it in places that don't have comps. And when I looked at his pro forma, I was like, well, you don't qualify. I mean, you're showing like a
You
12%
showed the
rate of
project
return. He's like, well, I could just adjust that. And I was just like, yeah, so no, it's not happening.
That's a
But
mistake, that's a rookie mistake by the developer.
Total rookie mistake.
Never show an
Yeah.
agency that you make money on a
Right.
project.
And I'll say he called a lot of people above my head, and they were just like, yeah, too bad. Like
You blew it.
And the project got built, it's fully leased, and so that happens, and part of what we pay attention to are those.
Well, and so that gets me, I mean, sort of back to my question is, we always hear, oh, it doesn't pencil out, it doesn't pencil out. So is there a way to know from X developer who's saying it doesn't pencil out, like, does he always say that? And, to check his prior pro formas and
Well,
how they've dealt and,
You won't get those, but one of the easiest ways to find out if it works or not is honestly, if it works, the private sector will just do it without intervention. So if you're in a market, right now, high-rises work in the Pearl, and so people build high-rises. If someone's building it, you say, if it doesn't work, then why'd they build it? They didn't have any intervention now. There's always a risk. So we always look at these things, and if you're talking mid-rise or the type of development forms you're talking about, Milwaukee, that's a stretch. That's hard to do. It's hard to do in Selwood too, particularly with construction costs moving up. In fact, the project
Are
that
construction costs still moving up?
they're starting to slow down, but they're still up. We have a labor shortage has been our problem. You should all encourage your kids to go into construction trades, not college. I
Engineering.
tried that with my son. He wanted to college anyways, but he should be in the trades. I mean, you could print money, but because we don't have enough kids going into trades, and everybody's retiring, and so they're actually getting a loss of productivity now because all these senior journeyman guys are retiring and they got no one coming in behind them.
Right.
And
It's
so
like the
it's a
mechanical,
problem.
electrical contracts that we had on the library when we went from, sorry, Jerry,
Go ahead,
50% construction documents to 100%, those two pricing exercises, we saw a massive jump. And in fact, that was, I think, something like 40% of the increase in cost was just for MEP because of the labor shortage.
Yeah,
'Cause
we've
they
got a
can just charge
shortage of
whatever they want.
electricians right now, and now you've got Intel's gonna do multi-billion-dollar
Yeah.
facility, which is gonna book every electrician for the next 2 years. And it's gonna be hard.
So just so people know, we have about 15 minutes of this
Yeah, we're-
conversation, so I just want to make sure
All
that
right.
Yeah.
we're getting
We
So
go
I
through all
I
the
wanted
these.
to back up on something you were talking about. You talked about not selling the land until you knew they're going to start construction tomorrow. Can you not structure the deal that says we will absolutely sell the land for this price or give it away for the thing we're getting for it the day the building opens? Because they could fail halfway in too, and then you're stuck with this derelict.
What-
You could also get a right to cure though,
Yeah,
which you can negotiate, which allows you, if he fails halfway through construction, you can now become the deal with the lender
right.
to pick up the project.
Okay.
But it's hard because the lender will want first position on a real piece of property, and if he doesn't own it, they get really skittish.
Right.
Yeah.
Yeah, so we would want, most developers will either want like a 100-year lease or they would want the land. In
But
order
if
to
there's a
get-
right to cure, that
Yeah,
solves the
but
problem.
that we would structure our agreement to have those
Yeah,
kinds
'cause
of
you don't want to go to the
clawbacks.
open market for the highest bidder. It goes back to the bank, and the lenders will hang with developer way too long. They should burn the developers on these things and sell them, but
Right,
they usually just do nothing, and it sits around half-built for
Exactly.
years,
Right.
yeah.
right, which is what happened in Beaverton, but they
Yeah.
didn't own the land,
Which is
didn't have a
what I
clawback.
definitely do
any of
not
that,
want.
and
Yeah, and all their
it sat
windows
there.
started to warp because they had wood windows,
Right.
and it was a mess.
Yeah, it was a mess.
Do you want to talk about green building at all? That was one.
Yeah, I mean, we can talk a little bit about that too. Jerry, if you want to weigh in on that, but,
I don't know much of the green building stuff. I was interested in the business case with it, because my students will always say they want to do this green stuff, and I just need the business case. Just
right,
what's it gonna cost, what are you gonna make from it, is it okay?
right.
It's a good marketing piece on the margin, but I need to see that it makes some sense.
Yeah, and so I think if you add additional construction costs, so let's just say, I don't know, add $25 a square foot.
That's a lot. Well, are you taking it to,
What kind of standard do we want?
are you gonna go to gold or platinum or living building challenge?
Living building challenge.
Then you're really expensive.
We're doing,
Earth Advantage.
well, or
Path.
net zero ready.
Yeah.
At zero, okay. Because right now, like code is silver.
Code is silver.
Pretty much if you just build it to code, you're
Yeah.
and you pay your consultant to certify you be silver.
Really? Portland, the Oregon Building Code is
Well, silver's so
essentially
easy.
lead
Yeah,
silver?
Because silver really doesn't have much in the way of energy.
Yeah, it's really pretty easy. You can just do
Silver
it.
is-
It means you paid $50,000 to your
Which
lead
is why I was
consultant.
pushing back
Right.
on silver being unacceptable.
But see, on a project.
Well, so is there a dollar figure is there somebody who knows what the dollar figure per square foot is for the different ones?
I'm gonna say no.
We've asked contractors this one, and it depends sometimes even on the configuration of your site. Do you where are you south facing? Can I do different things, or is this not
Right.
gonna work? I mean, there are
points
some-
vary. Sorry, points vary, so it's really hard to say that X is your spot price. We did look when we were working on the green building standard, and it was exceptionally difficult to find anything that had been published in the last 8 years that gave actual numbers. And it's because of that variability. In 2008, there were several studies out there that showed what kind of the cost of each of the different programs were, but there have been several new programs. We couldn't pinpoint it.
And there's always the construction costs, and then you're gonna, maybe have, lower operating on the other side. So it's, it's really an investment that
Depends
you're
on whether
putting in
the-
upfront that you'll be
it's an
making back
owner.
over time.
Well, the
Right.
difficulty, when we run it with owners, when normally the argument is, you get your operating costs lower, but most of these are pass-throughs, because now your office rents are triple net rents, which means you pass through operating costs. So if the guy is paying, the tenant is saving $2 a square foot a year, well, they pay $2 a square foot more for the rent. What they find is now they pay $1 a square foot more for their rent. They won't get full recovery. Like if you own the building and you were paying the operating cost, but nowadays, including with rental apartments, you push it to the tenant. So the question is, will I get the rent? Their operating costs are lower, but tenants always sort of fool themselves into thinking they'll just keep their heat off and do different things and save money if they need to.
Right, and residential, we've talked about before, is super hard to track in terms of energy consumption because it's such an individualized choice, whereas commercial office buildings are much easier to estimate, much easier to control because they have given hours, et
That's
cetera.
why my office is freezing all the time.
Yeah, I keep saying that's why mine is too. Damien took away all my heaters.
That's also true.
That's actually true, and thank you, Damien, for doing that.
It's true.
Yeah, but I think one project I'm working on now is the ETO gave us a sense of like what the costs were, and they ranged pretty dramatically from like the maximum to, and it was range from kind of the upper 100,000s to millions in terms of what the interventions would be. And so a lot of, like what a developer will do is weigh those sensitivities here, and then I think that's where, correct me if I'm wrong, but where having a long-term property owner, they're more likely to want to take on something like that because they will be getting those benefits
Well,
overall.
and some of the equity partners have different standards too, like CenterCal, all their new projects have to be LEED Platinum because their main investor is CalSTRS, the California State Teachers Union Pension Fund, and that's their requirement. Now, as a developer, actually Fred loves this because he gets paid as a development fee as a percentage of cost, and so if his costs are higher, he makes more money, he doesn't really care whether it returns or not. But you do have funds that actually will have that sort of guidance, and they'll take a lower return for green buildings. It limits your pool, but there are people out there who will do that. Or that's one of their criteria when they're looking at investments, that they try to hold certain things.
So this question is probably not, this really isn't about the Proformas, but it's a question that I've been kicking around and I've heard from some citizens is concern that we're only getting rental units and we're not getting condos. And that what do we do to make more of these be condos? And I know some of that is state law, right? There's some
state law, construction defect litigation reform.
Yeah.
You can do, but that's, obviously not your.
There's not a lot of condo being built these days.
Yeah, and the condos haven't been doing great.
Right.
The ones that have been
Well,
built.
it's because their value just tanks. It's like, it's worse than a car. You drive across the
Yeah.
lot and it's,
And so people get very nervous about the condos because the condo market is very volatile and it has been.
forever.
But, yeah, it's always been our issue. About every 40 years we go through a condo boom and then we don't do them for a while. People care about ownership for sure, and they'd like to see more ownership, and it's a price point that people would like to do. That form has just sort of gotten a bad name. Developers don't want to build it, and then people are afraid to own it too. It's also a financing problem, which we've run into. If you're looking for guarantees on financing, a lot of these were done with FHA guarantees that they got skittish because condo projects turned into apartment projects in the downturn. Because they couldn't sell them, but you get stuck with this project now that I've got 8 condos sold, the rest of them are apartments, and it's this weird situation. And so the lenders got skittish because they don't want to be lending on a condo that suddenly becomes an apartment building. And so now you get guarantees, but you can't get guarantees until I get 65% pre-sales, but I can't get 65% pre-sales without my guarantees, and so you get this chicken egg project. Problem trying to sell these things that I can't get my sales up high enough to get them financed, and the financing won't come in until my sales are high enough. So it's been a difficulty on both sides. So nobody wants to build them and nobody wants to buy them. And nobody wants to finance them.
Well, as you
So
say,
there's-
here I will tell you, I've been watching them for a friend of mine, and at North Main, they're sold like that. They come open and they're sold fast.
Yeah.
And also out at the condos out at Waverly, they sell really fast.
Are those townhome style though? 'Cause I guess I was gonna ask Jerry.
Be simple.
Be simple, yeah.
The ones at Waverly are not, but the ones at
North Main
North Main
are,
are,
'cause
yeah.
It's a little off topic, but
Yeah.
relevant is sort of this House Bill 2001, and I was looking at other housing options. I guess since we have you here, I'll put you on the spot,
I don't
Jerry.
know what the implication
But
is.
just, are there other models of ownership, fee simple ownership that aren't in a multi-story building? So townhomes,
Oh, yeah.
duplexes, triplex, things like
The
that.
cottage
Are
homes,
those-
all that
Cottage
stuff.
clusters, yeah.
Yeah.
Yeah, to cut, I mean,
Are
all
those
those,
easier to
all
do
those
for
middle housing
non-residents?
pieces, the thing that they like for financing and it makes people comfortable is fee simple ownership, even in townhomes. People are much more comfortable with I own the ground and I own up in a vertical stack. Even if I have a shared wall, they just tend to be more comfortable with that. The condos are okay. People hate their condo associations.
They hate the fee, they hate the
And
HOA,
they hate
yeah.
the HOA fee, and suddenly they've got dues that are contingent on everybody voting, and
Yeah.
they may get voted higher fees, and they don't like it, or they may hate their neighbor. You always you can hate your neighbor, though. That's
Yeah.
a single family thing, too.
There's a little further away,
Yeah.
but not much.
Yeah, you can have a big fence or something, but, I mean, all that stuff that's the middle housing things they're all things we're trying to get to. I did the home builder forecast breakfast last week, and I've been trying to encourage them to build more to that because they're just missing their price point. I mean, one of the reasons the apartment market has been able to absorb as much as it has, which is startling how much actual net absorption we've had in the rental apartment market, because you would think we'd be overbuilding with as much product as we have, is the percentage of people who can own keeps going down because the price has just gotten away from people. So right before the bus, we got up to 69% home ownership. We're down to like 58%, and it's dropping still.
Not surprising.
And people just can't get into the ownership market. It's getting away from them. So you're trying to come up with other products for the home builders where they can get a broader swath of the market, or they're just going to be a smaller industry. Right now, they're only building half the homes they would have normally built in an expansion cycle because they can only build to a price point that no one's at. So it's a small
Well,
market.
we're seeing that here, for sure.
Yeah.
Yeah, so if you can't build anything below $500,000, there's not that many people to sell it to, so it's a smaller industry.
So that's why I was hoping you were gonna say the costs of construction were going down finally, but.
Eventually, the problem is we've never seen, and we talked to the old, I've been unfortunately doing this long enough that I've been through a lot of cycles, and we hardly ever see it go down a lot. It sort of plateaus,
Yeah.
and it'll sit still for a while, which would be fine if it sits still for like 5 or 6 years. I hear that excavators are now starting to show a little bit of weakness, which
They're the first ones.
they're
on
the first
site.
ones on the site, so that's a good sign. So,
The others.
yeah, we're hoping the rest of them will start. When they start sharpening their pencils is when they see their backlog go down and they're not booked. If they're booked for the next year, it's really hard to get them to, give you a tight bid.
Yeah, can't even get an electrician to come to my house.
So I think we're getting to the end of our time, and you're starting to look like me at the end of a class. I'm just kidding. Very attentive, excellent questions. We hope this was helpful. Are there any parting questions that y'all have, or?
Anything you want to follow
So
up
I guess
on?
it's
Yeah.
always been the question, internal rate of return, I forget, what was the number where it kicked into the green? What was?
12%.
You said it at 12.
And what's magic about 12?
There's nothing magic. It's a bit of a play. And again, it goes up and down with interest rates, just like everything else. So there isn't a magic thing. And you'll find some developers who will take a low rate of return, and others will take a higher rate. We've done work for Middle Eastern investors that do 40-year pro formas.
So they'll take a lower rate.
They'll
of
take a
return.
very low rate of return for a long-term hold. And people just have different perspectives on how they look at these things.
So in the garbage hauler line, we look at a 10%, right?
Right.
So I mean, that's, I guess, the same
But
ballpark.
the 10% could be your cash on cash, which would be pretty consistent with what a developer would look at as far as what, money out of my pocket, money into my pocket, I'm getting about 10%. That's the cash on cash. The internal rate of return reflects the fact that I sold it, 10 years out and I paid off the remaining debt and I get this lump of sum. So it tends to be higher. But most people don't think that way. They just are thinking, I've got this much out of pocket and I'm getting this much money back every year.
Okay. Well, thank you. It was a great conversation. Really appreciated your
Thank you.
questions.
Thank you, yeah.
Yeah, this was really useful. This is exactly what a study session should be. by the
Good.
way. I think you
Well, we have
you nailed
Professor
it.
Johnson.
Thanks again, Terry.
Layla?
We got a little bit of this in Moving Forward Milwaukee, but we didn't get this level of
Yeah.
detail, so this was good.
Would there be any possibility that we could play with this?
You bet. Yeah, it's an open source model, so I'll send it around to council.
That'd be great.
Yeah.
And is there any kind of, without getting a, 40-page document, is there any kind of like 3 or 4-page version of all these acronyms and all these calculations of?
It's actually in your model. You've got a little,
Oh, it pops up?
no, you guys have a little sheet in here. I was looking for
Yeah,
this
it's
thing.
like that.
Is it right at the beginning or is it later? You guys-
Can't remember.
I was actually going to steal some of that language. I was looking at the
It's open
text
source,
again.
Jerry. It's all free.
I know, because I had been looking at it thinking I could take some of
I'll find it for you, Lisa. If
Okay.
it's not,
Okay.
we'll
Okay.
get it to you.
Great,
Yeah,
thanks.
it's like a definitions page.
Yeah.
Yeah.
Yeah,
And you've got us too, so if you have any questions, you can always ask.
that's fine. I haven't played with this model for a while.
That's cool.
I used to play with it before,
Yeah.
a long time ago.
Oh, sorry, Scott, I just closed your Okay.
So we're adjourned on this section of the study session.